Welcome to Trader TV Credit, your insight into the trading climate for professional investors in corporate bonds. I'm Dan Barnes. In January's show, we're revealing the impact of MiFID II rules on investment trading, which came into effect on the 3rd of January. Investment managers have to manage the impact of the new rules on behalf of their investors. To find out how, we're going to speak with Lee Sanders, Head of Foreign Exchange and Fixed Income Dealing at AXA Investment Managers, Gianluca Minieri, Deputy Global Head of Trading at Amundi Asset Management, and Lee Bartholomew, Head of Fixed Income at derivatives exchange Eurex. Firstly, we'll speak with Lee Sanders and Gianluca Minieri. Gentlemen, welcome to Trader TV.
Thanks, Dan.
Thanks for having me.
You're welcome. So MiFID II is a piece of legislation which is designed to protect investors. However, over the short to medium term, it could have a negative impact on trading. What's been your experience of the impact day one and for the first couple of weeks?
I think a lot of the banks had squared up inventory into the end of the year, so the market was slightly thin anyway. So things were a little bit hard to find to begin with. But as the street got its inventory back, the market seemed, as it had last year, very normal. And then I think there was a bit more focus on the data, from a desk perspective, what we were seeing, how it was being printed, looking at kind of time delays and waivers and making sure we were happy with that. But I think generally for the corporate bond market, it's performed amazingly well. Turnover is up. Some of the ECNs were saying, over the small universe that we have, is up about 40%. A lot more trading going through on process trades, so executed by voice, but then booked through an MTF to record it promptly. And the other thing which Gianluca and I will probably talk about a bit is the data going downstream, the trade reporting, which I think most firms just settled into that quite well. There were some legal entity indicator kind of issues, but they were ironed out very quickly. Mm-hmm. And I think those who've used an APA have found it very easy. It's probably been a bit more strenuous for people who are doing their self-reporting. But on the whole, at AXA IM, we're very happy with the initial onboarding of MiFID II.
I think there are risks behind the corner, for sure. So, the implementation has been very smooth, but to be fair, I think the market is still in a very benign environment. There is low volatility, the market is still well supported. So it'd be interesting to see what happens when and if volatility will get back into the market. On the credit market in particular, as we know, the majority of the market is still over the phone. So, and we all know that it will take longer to trade over the phone because the brokers will have to log in their request for trade, for voice trade. There is a timestamp required, every time you do a voice trade. So now everything seems to be quite smooth. It'll be interesting to see if volatility get back into the market, how this will translate into voice trading.
The reporting process, that's an ongoing one, isn't it? And the release of data is ongoing. So do you expect that to have an impact over the longer term, which may perhaps impact liquidity?
Yeah, definitely. As I said, it will take time to see the impact of data on our activity. While I think in a few months, probably years, when the publication of data will be more regulated and people will be comfortable with that, I think it will bring benefit to the fixed income market overall. Now, clearly, the federal regime, for example, consistency across the federal regime is a big thing for us because it is important that you know exactly when you trade with someone what is going to be the time by when your trade is going to be reported and published.
I think transparency has its pros and it has its cons. We're always very cognizant of the fact that market makers don't like to see trades lit up too much while they're unwinding that risk. And I think the delay is very useful to make sure that that's the case. I think I'll have to iron out people instantaneously seeing some of those prints, which is a slight issue for us in the early onsets of MiFID II reporting. But I think, to Gianluca's point, I think the market will navigate to a fairer, more transparent regime. Also with the data, I think one thing which we've always been striving for in fixed income is better transaction cost analysis. And I think this will be very good to evidence the quality of the execution that trading desks are getting on behalf of their clients.
And so if you're looking at the actual cost to the end investor of the investment process, overall, do you expect MiFID II to have an impact and how will that play out?
you know, it's a very competitive world in charging for asset management mandates, and I think it will continue to be very competitive. I think people who you know, try to put those costs onto the end user probably haven't got the right business model in this environment.
We've talked about the fact that there's going to be more data released, but obviously you actually have to gather this. You have to have potentially an aggregated source. There's been talk of the European Securities and Markets Authority providing that themselves, potentially. But you need to then make sure that you can use this for the investment process and the trading process effectively. What are you doing, and how your team is preparing to gather that information, to pull it together and to make best use of it?
We have built quite a good technological infrastructure, so we are completely relying on our OMS and our capability to retain, manage, crunch and analyze the huge amount of data that we now have available, you know, to perform our work. So again, it's still a bit too early to be able to determine the real impact, because again, the amount of data that we have to manage is dramatically, significantly increased, you know, from a pre-MiFID II environment. But my answer would be to invest into technology.
I think how it comes into, agree with Gianluca, how it comes into the OMSs and the EMSs is going to be key for us, and how we use that information more and more through the execution process and through, I totally agree with Gianluca's point, through the investment process, you know, giving a lot of that information to fund managers on portfolio construction, highlighting bonds which are more liquid than others, I think is very much key to the whole process as well. But it's early days, you know, we've got to look at how we, you know, what we're going to get in, how relevant it is, and what we can do with it going forward. But it's quite exciting, I think, Dan.
That's great, thank you very much. Now, one of the key things that's going to be released by MiFID II is the idea of the best execution reports. There's an annual report at the end of the year. End investors get to see how trading decisions were made, or which trading decisions were made. That's quite a change. And of course, in corporate bonds particularly, where you can see a lot of different reasons for an execution decision being made, I imagine it's quite a complex thing to explain to the end investor. How do you see that playing out?
Every trade now is in some way assessed by, I mean, at AXA IM we have a three-person team in Paris and one guy in London called Business Quality. So they run over all of the trades, make sure that it complies with our best ex policy, and anything that looks like it's slightly out is challenged back to the trader. So traders over this period have been very communicative with this team to ensure that the process around selection, you know, of counterparty or the price has all been documented when it might look slightly opaque. And we think, you know, this is something which is a massive benefit. It makes traders think a lot more trade by trade.
With MiFID II, we will have more data available. So I actually see this as incredibly positive for the clients, because more data from a TCA perspective means that there will be TCA provider that will be capable to provide some meaningful methodologies, you know, to perform a good analysis. So I'm much more positive today than in a pre-MiFID II world.
Lee Sanders, Gianluca Minieri, thank you very much.
Thank you, Dan.
Thank you.
When cash bonds in the credit market prove too costly to trade, derivatives can be a more liquid option. Now we're going to speak with Lee Bartholomew, Head of Fixed Income and FX Products R&D at Eurex, about the use of non-cash instruments for accessing the corporate bond market. Lee, welcome to Trader TV.
Dan, thank you very much for having me.
When firms are talking about the credit market particularly, often they express frustration with the lack of liquidity in the market. How do futures then play into their ability to trade?
For me, there's a little bit of a kind of a misconception that there is a problem with liquidity. I think there has always been pockets where you'll have more liquidity in certain parts of the curve or certain names than others, and that's a challenge that we all have to overcome. I think one of the appeals of the futures for us was to take a step back and for us to say, well, what does our product mix look like? And I think credit is one of those markets from an OTC perspective that is yet to see the incremental or the uplift in electronification that we've seen in some of the other markets, so albeit rates or equities. So what I see the product as doing is being complementary to the cash market. So Why do I think that? Well, I think that because what you tend to do when you're launching a product on an exchange is you bring in alternative liquidity providers. So I think with the growth of ETFs, from a cash perspective, that's actually helped the credit market, because what you've then seen is equity desks at some of the exchange market making companies then stepping into that gap that some of the banks have kind of reduced their exposure to, and actually come in to provide liquidity. So over the course of this year and next, I would think that this would help to bring liquidity, A, to the market, and then help with pricing overall.
And then taking this in the context of MiFID II, potentially how does MiFID II change the liquidity and pricing challenges for buy-side desks in particular? And how do you think that this product will then assist them or affect the way they're acting?
Yeah, I think for me, I go back to kind of the growth across the board, because I think the cash market has seen huge growth in high yield and so forth, and then you've seen kind of the ETFs come along at the same time. So the reason I use both of them in terms of the impact on MiFID, because I think that's two of the most important factors, and then I think is the best execution is another one. So I think under best execution in MiFID II, you'll see more asset managers kind of go to a more algorithmic execution, which for me then appeals to an exchange traded derivative. That's one aspect. And then on the credit side, what you look at from a real money, or what I would expect them to be considering more, is A, what's the initial liquidity in there? B, does it correlate to my underlying portfolio, or is it uncorrelated? What is the relationship to it to rates? Because I see the product for me having a number of uses. It can be used as a relative value tool to trade rates, equity, and credit. So for me, what the consideration has got to be is A, what's the liquidity? From a capital perspective, it's beneficial. And also from a kind of a simple ease of use, people are comfortable trading futures. And also can you bring more liquidity providers as we evolve with the product over time?
We've certainly seen some of the buy-side traders talk about the growth of listed products rather than OTC perhaps in terms of what they're trading. Now, do you see them then using this more for liquidity purposes or hedging purposes?
I think for me, it's dependent upon the portfolio manager and the kind of their remit. So I think if you're a traditional asset manager, you might use it to leverage or deleverage your cash portfolio or view. If you're using it as a kind of a macro relative value play, then for me, you're looking at the kind of the correlation with rates and equities. So, your hold period might be less because you've got it embedded within kind of a bigger overall view.
Yes.
And then from my perspective, it's a case of just getting both the buy and sell side comfortable with providing liquidity in an exchange traded derivative, because what you've found is the kind of the technology that you need in order to kind of stream prices, the banks are developing within their credit businesses, because what that does is it helps them kind of build out other revenue streams in ETFs, for example.
And do you have any predictions in terms of volume or expectations perhaps?
I think for me, it's a new product. So I think it's going to take longer to build momentum than a typical, say, for example, BTP options, which we did last year as well. I think for me, it's much more of a mindset change for some people. So looking at credit to say, we have now a listed alternative that we can use within. So again, I see it as complementary, not there to replace. And I think the other thing for me is how you then, the evolution of the retail network within Europe, but then how desks evolve from an execution perspective. So I think dependent upon the asset manager or the hedge fund, they're at varying degrees of sophistication. And those that embed AI and electronic execution quicker will embed the exchange traded derivatives a lot quicker.
And then potentially drive down their trading costs, increase their capacity to find liquidity.
Yes, I mean, sure, for me, I think total trading cost is something which is going to become more and more prominent as we step through, both from the buy side and the sell side. If I'm on a trading desk, I've got to look at a product and say, what is the appeal versus the capital that I need to put up against it. Obviously, with a future, you have 2-day margining rather than 5 days, so that is an appeal in itself. But you've also got to be confident that there's the supply and demand there, and vice versa for the real money side.
Got it. Lee Bartholomew, thank you very much.
Thank you very much for having me, Dan.
I'd like to thank our guests, Lee Sanders at AXA Investment Managers, Gianluca Minieri at Amundi Asset Management, and Lee Bartholomew of Eurex, and you for watching. We're also covering the impact of MiFID II across the equity and rates markets this month. Visit us at tradertv.net.